US Indices Price versus trading range as of 1/8/2026. This is not a crash call. This is not a doom headline. It's a warning that markets only whisper before they scream. What you're looking at on your screen is not a price chart. It's not a valuation. It's something far more dangerous when ignored. This is a market positioning and exhaustion map. And right now, almost every major US equity index is flashing the same message. You are late, risk is mispriced, and upside is shrinking fast. This is not a predictive chart. It does not tell you when something breaks. It tells you how vulnerable the market if something does. This chart answers one question only. Where are pricing sitting inside their trading range across the entire US equity complex? And when everything answers that question the same way, markets pay attention. So how are we going to read this chart first? On the left side is the index coverage. This chart runs top to bottom by market size, as you could see. First you've got the Russell 2000 all the way up to the S&P 100 ETF. So this is a breadth and momentum diagnostics. That's what this is. So what you're looking at is you go from micro caps all the way to mega cap benchmark. This matters because risk never hides in one corner, and it's all about risk. It migrates. And every segment lines up. This is what you call systemic risk. So that's on the left. The middle section, you'll see three columns. The year-to-date, the 5 years, and 50 DMA, which is a distance from the 50-day moving average. So in the middle, year-to-date, you have the price, obviously, but you have the year-to-date, the 5 days, and the 50-day DMA. So here's the first red flag. Smaller stocks, micro, small, and mini caps are outperforming short term. Why do I say that? Well, look at the number. 4.9, 4.78, 4.4. Year to date, they are higher than, so basically, and this was something I've been saying since last year, go for the small caps. Look, compared to everything else, the Russell 100, the total stock market, and all that. And this is not a sign of safety. This is a sign of late cycle risk appetite. Small caps don't lead early stability. They lead liquidity chasing. But because everything is so high, you're going to have to, well, what else haven't we bought yet? The arrows tells you the trending direction. Take a look at the arrow on the right. It says trend. It's green, 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 orange, 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 green, 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 all green. Almost everything is still trending up. This is not a bearish trend breakdown. This is something more subtle and more dangerous. Now focus your eyes on the far right. That is where the message becomes unavoidable. Overbought, neutral. This is not an opinion. It's mathematically positioning relative to recent price changes. That's what it says. The black line and dot, the black line shows the full recent trading range. You could see how far it drops, and it basically, you could see it goes into overbought territory. All of them are the green and the orange. The white is, the white is neutral, but you have overbought, and this is where they are. With the little green arrow at the end, green circle. So the dot shows where price currently sits inside that range. Did you notice? They all sit at the end of the range, on all of them. Dots on the far right edge means price is pressing the upper boundary. Upside historically slows and downside accelerates. Almost everything is flagged overbought. Not one sector, not one index, not one corner. Everything. That doesn't happen in a healthy early cycle market. So markets can't stay overbought forever, but markets rarely stay broadly overbought without consequences. When this happens, only three things follows. One, sideways churn that destroy returns through time. Fast pullbacks that reset position. Volatility spikes that punish leverage and complacency. Notice that this doesn't imply that there's going to be a crash tomorrow. It implies asymmetric risk. Upside becomes slow, the downside becomes fast. So basically, what we're doing, we're not saying sell everything. We're saying is you are aware that there's risk of crossing the street with your eyes closed. I'm not saying don't cross the street. I'm not saying you're going to get run over. I don't know. It's maybe midnight. There's no cars around. But you're crossing with your eyes closed. So let's look again at the top of the chart. The micro caps and small caps are the most overbought. This is historically critical. What do I mean? Well, small caps depend on liquidity. 2, depends on easy financial conditions. 3, they break first when risk tightens. They don't lead safely. They lead a late stage enthusiasm. When they roll, they rarely warn politely. Now notice something subtle but critical. The largest, most liquid indices, the mega cap tech, are only neutral, not overbought. You see what I'm talking about? If you go all the way down, the Invesco NASDAQ 100, that's the top 100, tech firm, basically. This tells us something powerful, that it's not a tech-led melt-up. This is a breath chase. Breath chases are quiet until they don't. So don't look at this chart as being bearish, but as unforgiving. It tells you risk is poorly priced. Positioning is crowded. Returns are being borrowed from the future. And the most dangerous thing investors can do here is confuse positive trend knowing with low risk. Because this chart is saying very clearly, you are no longer being paid for optimism. You are being charged for it. So manage accordingly.